Hello everyone, in this review exercise we're going to be booking some journal entries for daily golf lessons, and then at the end of the period after we've booked all of the entries we're going to determine what the balance is of Daly's cash account. In our first journal entry, Daily Golf Lessons owner Ron Daly is going to contribute $10,000 cash and $1,000 worth of equipment to the business. He's going to receive capital in exchange. So what accounts are being affected here? Well, the two of them are going to be what Mr. Daly is contributing. And he's contributing cash and equipment. The other account being affected is what he's getting in exchange, and that is capital, an increased stake in ownership of the business. He should, have more right to the business's assets because he just contributed a bunch of his own stuff to Daily Golf Lessons. Cash and equipment are both assets, while daily capital is an equity account. The amount of cash the business has is going to increase after he contributes that to $10,000. The amount of equipment they have is going to increase after he contributes that $1,000 worth of equipment. And again, his stake in the business is also going to go up. Assets go up with a debit and down with a credit, so we're going to debit both cash and equipment. Equity accounts go down with a debit and up with a credit, which means we're going to credit daily capital. So the January 1st entry to record this contribution is a debit to cash for $10,000, a credit or debit to equipment for $1,000, and a credit to daily capital for the total amount of the contribution, which is $11,000. And that's our entry to record this owner contribution. Next up, on January 2nd, Daily Golf Lessons is going to provide services worth $50 to a customer and be paid in cash. So what did we do to earn revenue? How were we paid? Well, we were paid in cash, and what we did to earn that revenue was provide a service. So our two accounts being affected are cash and service revenue. Cash is an asset, service revenue is a revenue account. Are they increasing or decreasing? Well, we just got paid by a customer, so the business's cash account, the amount of money they have in the bank, has to be going up. Revenue tracks how much service we provided in total to all of our customers over a period. Well, we just did another service, which means that also has to be going up. And assets go up with a debit. Revenue accounts go down with a debit and up with a credit, so we're going to credit service revenue. So our January 2nd entry to record these services provided to the customer is going to be a debit to cash for the $50 and a credit to service revenue for that same $50 when we performed cash services. Next, on January 3rd, Daily Golf Lessons is going to provide $80 worth of services on account to a customer. So now we're not getting cash. We're billing the customer is going to owe us. And when somebody owes your company something that stemmed from the normal course of business, it gets recorded as a receivable in an account called accounts receivable. But still, we did the services, so we get to put the services on the books because we performed the obligation we had to this customer. We provided golf lessons, so even though they're not paying us yet, we still get to record the revenues because we actually did the job. Accounts receivable is an asset, service revenue is a revenue account. Accounts receivable tracks how much money is owed to your business in total. Well, if we're billing another customer who's going to owe us money, the total amount of money owed to Daily Golf Lessons has to be going up. And again, we're recording revenue here, which tracks how much service we provided. We just did another job. That has to be going up as well. Assets go up with a debit, while revenues go up with a credit. So the journal entry on January 3rd is a debit to accounts receivable for $80 and a credit to service revenue for $80 in the entry, which records the fact that we performed services for a customer on account. Next up, on January 4th, Daily Golf Lessons is going to purchase $300 worth of promotion flyers, and they're going to pay for these in cash. So these flyers that we are buying are to let people know what we do, that we provide golf lessons. We are advertising to the public, and we're going to record that as an advertising expense as one of our accounts. That's what we're buying. We're buying flyers for the purpose of promotion, for the purpose of advertising. How are we paying for those flyers? In cash. Those are the two accounts that are going to be affected here. Advertising expense is an expense account, while cash is an asset. Advertising expense tracks how much money we've spent in total advertising our business over a period of time. We just spent $300 more to buy these flyers, so that's got to be going up. And since we're sending the cash out to whatever company made us these flyers, our cash has to be going down. Expenses go up with a debit, down with a credit, which means we're going to debit advertising expense in this entry, and we are going to credit cash because assets decrease on the credit side. So on January 4th, we have a debit to advertising expense for $300, credit to cash for that same amount, and the entry which records the fact that we paid cash for advertising. On January 5th, Daily Golf Lessons is going to purchase $300 worth of golf equipment on account. So what accounts are being affected? Let's ask ourselves, what are we buying? How are we paying for it? Well, we're buying equipment, so that's one of the accounts that has to be affected. How are we paying for it? At this point, we're not. We're buying it on account, which means we're getting the equipment and we're getting billed by whoever we bought the equipment from, and we have to pay them later. And that means we owe something, which in accounting lingo we're going to call an account payable. So our two accounts being affected are equipment and accounts payable. Equipment is an asset. Accounts payable, we owe something to somebody. That is a liability. The amount of equipment our business has in total is going to increase after this transaction, while the amount of money we owe to other parties in total is going to also increase, because now we owe more money to people outside of our business because we just bought this on credit, if you will. So assets are going to go up on the debit side. Liabilities go down with a debit, up with a credit. Since our liability is going up here, we're going to credit accounts payable. And on January 5th, we're going to have an entry which debits equipment for the cost of the equipment, $300, credits accounts payable for the same amount. And with that, we have recorded our journal entry for the fact that we purchased equipment on account. On January 7th, Daily Golf Lessons is going to purchase $40 worth of cleaning supplies, and they're going to do so in cash. We'll ask ourselves the same question. What are we buying? How are we paying for it? We're buying supplies. How are we paying for it? We're paying in cash. Those have to be the two accounts that are being affected. Supplies is something we're going to use to help us turn a profit in the future, and then is therefore an asset, as is cash. The amount of supplies our business owns after we purchase more of them has to be going up, and since we're paying for these supplies, our cash has to be going down. Assets increase on the debit side, decrease on the credit side, which means our journal entry on January 7th is a debit to supplies for the $40 that we are buying worth of supplies, and a credit to cash for that same amount. On January 10th, Daily Golf Lessons is going to provide $500 worth of services for a youth activity center. This activity center is going to pay us $100 at the time the services are rendered, and we're going to bill them for the remaining balance. Well, now we got three accounts being affected because we're getting a down payment, and that means we're getting money right now, so cash has to be affected. But we're not getting the total amount of money that we have earned from doing this job. They owe us the remainder of that amount, so that means we have to put a receivable on the books. This youth activity center is going to be paying us at some point in the future. And what did we do to earn that down payment? What did we do to be able to bill them for the remaining balance? We provided a service. So service revenue is going to be our third account. Cash and accounts receivable are both assets, while service revenue is a revenue account. The amount of cash our business has after we receive that $100 down payment is going to be going up. The amount of money owed to us by other parties is going to be going up because we just built this youth activity center. And the amount of services we provided during the period which we are tracking also has to be going up because we just did another job. Assets increase on the debit side while revenues increase on the credit side. So our journal entry on January 10th is to debit cash for the amount of the down payment, which was $100. To debit accounts receivable for the amount that they still owe us that we're going to bill them for. If we provided $500 worth of services and they gave us $100, they still owe us $400. And we're going to record a credit to service revenue for the full lot because we performed those $500 worth of services even though we haven't gotten full payment yet. And that is our entry to record the payment or the receipt of a down payment and the billing of this youth activity center for the services that we have provided. On January 14th, Daily Golf Lessons is going to sign a promissory note with a local bank to take out a $5,000 small business loan, and they're going to receive cash at the time of signing. So one of the accounts being affected here is cash. What did we do to get this cash? We took out, in other words, a loan from this local bank. Well, in accounting lingo, they refer to the fact that you have to sign a note with the place that's letting you borrow money that says, yes, we agree to repay you. So the term that they use for borrowing, which stems from financial activities, from borrowing from a bank, not owing money to a vendor or something, but purely getting money from financing, is referred to as notes payable. Cash is an asset. Notes payable ends with the word payable, so it's a liability. Our cash account is increasing while our liability account is also increasing, because now we owe more money to institutions that let us borrow in the first place, because we just borrowed another $5,000. Assets go up on the debit side, liabilities go up on the credit side. So the January 14th entry for daily golf lessons is a debit to cash for the amount that we're receiving, $5,000, and a credit to notes payable for that same amount. On January 16th, Daily Golf Lessons is going to receive $180 for services which were previously rendered on account. What does that mean? It means in the past we did services and we billed people for it and they owed us money. Well, now they're actually paying us. So one of the accounts that's going to be affected, since they're actually paying us, is cash. What other account is going to be affected? Well, if they're paying us, they no longer owe us. So we can't have on our books the account which tracks how much money is owed to us. People in total owe us less money, which means we have to change the balance of our accounts receivable. They are both asset accounts. Cash is going to be going up because we're getting $180. Accounts receivable is going to be going down because after this $180 is paid off, people owe us less money in total. And assets go up with a debit and down with a credit, which means the January 16th entry is a debit to cash for $180 and a credit to accounts receivable for that same amount. In the journal entry, which records the receipt of payment for services rendered in the past. On January 20th, Daily Golf Lessons is going to pay $300 that it owed to the vendor for the equipment which was purchased on January 5th. So on the 5th, when we got this equipment, we didn't pay at the time. We got sent a bill. Well, now we're paying off that bill. One of the accounts going to be affected is the fact that we no longer owe that money to someone. We're not liable to pay as much money to people outside of our business. We need to change the balance of our accounts payable. And since we're actually paying off our debt, what else has to be affected? Cash, because we're transferring it from our bank account to this vendor to pay off our debt to them. Accounts payable is a liability account, while cash is an asset. Accounts payable is the amount of money we owe to people. Well, if we're paying off some debt, we owe less money in total to people outside of our business, which means our liability account has to be going down. And since we're transferring the money from our bank account to these other parties, the amount of cash we have also has to be decreasing. What side do these accounts increase or decrease on? Liabilities go down with a debit, up with a credit, which means since our accounts payable liability is going down, we're going to debit that account. Assets go up with a debit and down with a credit. Since our asset is decreasing, that's going to be our credit in this journal entry. And on January 20th, we're going to debit accounts payable for $300. We're going to credit cash for that same $300. In the journal entry that records the fact that we paid off our balance to this vendor. On January 24th, Daily Golf Lessons is going to sign a 1-year $1,200 contract to provide future monthly services to a local middle school. At the time that we sign this contract, we're going to receive payment in full, which means this school is giving us the $1,200 at the time of its signing. However, we're not doing the services that day. We don't start the services until February 1st, and we're going to do them every month for the next year. So what accounts are being affected here? Well, we're getting paid in full in advance of doing any type of service, which means cash has to be affected. We're actually getting the $1,200 today. For the other account, we can't record this as service revenue. Why? Because we haven't fulfilled any of our obligations to this middle school. Yes, we signed the contract on January 24th, but we don't start giving lessons till February 1st. So we can't say that we provided services because we haven't provided services. Well, what do we record it as? This isn't revenue that we've earned yet, so we're going to record it at an account called unearned revenue. Cash is an asset. Unearned revenue means we owe something to someone. We owe, in this case, the middle school services, and when you owe something, it is a liability. The amount of cash we have is going up, The amount of work we owe to other people for which they've already paid is also going up. Assets go up on the debit side, liabilities go up on the credit side. So our January 24th entry is a debit to cash for $1,200 and a credit to unearned revenue for that same amount. On January 29th, Daily Golf Lessons is going to receive a utility bill in the mail. $125 of these utilities are assigned to the business. That's the amount we're going to put on the business's books is $125. But we're not going to actually pay off this bill until February. Well, this bill is for the utilities that we used in January, and since it happened in January, we're gonna want the fact that we used utilities on the books in the same month. So one of the accounts that's going to be affected is our utilities expense, but we're not actually paying the bill at the time, so cash isn't being affected. We owe something. We owe our utility company money for the utilities that we used during January. I booked this as its own separate liability called utilities payable because it's something that's going to happen each and every month. We're probably going to have utilities payable on our books constantly. I like to have it as a separate account just so I know how much I owe specifically for utilities. Utilities expense is an expense account. Utilities payable ends in the word payable, which automatically means that it's a liability. Expense accounts track how much you've spent on one given thing over a period of time. So the amount of money amount of debt that we've incurred for utilities is increasing because now we got a new bill. The amount of money we owe to our utility company since this new bill came in is also increasing. Expenses go up with a debit, down with a credit, so we're going to debit utilities expense. Liabilities go down with a debit, up with a credit, which means we're going to credit utilities payable. So on January 29th, we debit utilities expense for $125, we credit utilities payable for $125, and we recorded the receipt of a utility bill. On January 31st, Daily Golf Lessons owner Ron Daly is going to withdraw $800 from the business for his own personal use. So Mr. Daly wants to buy something that costs $800, but whatever he is purchasing isn't going to be useful to providing golf lessons. And since it's not useful in what the business does, you can't put it on the books as a business asset, which means the owner has to first formally withdraw the money. And you do that in a withdrawal account for your owner. So we're going to call this one Daily Withdrawals. What is Mr. Daly taking out of the business? He's taking out cash. So anytime there's an owner withdrawal, the owner's withdrawal account and your cash account are the two accounts being affected. Daily withdrawals is going to be a withdrawals account, while cash is an asset. Withdrawals are they increasing or decreasing? Withdrawals tracks how much money your owner has taken out of the business over a period of time. Well, he just took another withdrawal from the business, so that has to be increasing. And since the money's coming out of the business and going into his pocket for personal use, the amount of cash in the company bank account has to be going down. Withdrawals go up with a debit and down with a credit, so we're going to debit daily withdrawals. All assets go down on the credit side, so we're going to credit cash. And on January 31st, when we book this, we're going to debit daily withdrawals for the amount he withdrew, $800, and credit cash for that same amount to record this owner withdrawal. So now that we're through the month, we want to figure out what the balance of the cash account is. And to do so, we're going to use a T account. And all we're going to do is we're going to go back, look through all of our journal entries that we had where cash was one of the line items on our journal entry. We had 10 in total during this month, and I have them all on the screen right now. How do we find the balance? Well, it's pretty simple. You take whatever you did to cash in the journal entry and you transfer it to the T account. On January 1st, we debited cash for $10,000. Which means we're going to transfer that January 1st debit over to our T account. So we put it on the left hand side. On January 2nd, we debited cash for another $50, so we're going to throw that into the T account. On January 4th, we credited cash for $300 in the journal entry, so let's put it on the credit side of the T account. On January 7th, we're crediting cash for another $40. Next entry on January 10th, we debited cash for $100. So let's debit in the T account. On January 14th, we took out that loan and we got $5,000 in cash. So we debited cash in the journal entry where we're going to debit it in our T account. On January 16th, we debited cash for 180 bucks. We threw that into the T account. On January 20th, we credited cash for $300 when we paid off our account for that equipment we had previously purchased, and let's credit that in the T account. On January 24th, we debited cash for $1,200, and on January 31st, we credited cash for $800 when the owner made a withdrawal. Well, now we got to find the balance of our T account, and to find the balance, you have to know what side that account increases on and what side that account decreases on. Cash is an asset, so it increases on the debit side, decreases on the credit side. To find the balance of your T, you add up all of your debits, subtract out all of your credits for this asset account. So when we add up all of our debits in this T, subtract out the 4 credits that we have, we're going to come up with $15,090. So at the end of the period, Daily Golf Lessons has $15,090 in its bank account.